I've noticed that there's a lot of confusion when it comes to the different investing accounts that you have access to, and then also the different retirement accounts that you have access to investing for your retirement. So I'm particularly talking about accounts such as the 401k, the IRA, the Roth versions of those accounts, the traditional brokerage account, and then also the self-employment retirement accounts. What I want to talk about are some of the differences between these accounts, things that you need to pay attention to, also the limitations with some of these accounts, and then the disadvantages and some of the advantages, and then also some of the things that you have to think about when it comes to taxes and the employee sponsored investment and retirement accounts versus the ones that you can open outside of your employment. Let's talk about the first one, which is the 401k. Now, a 401k is an employer sponsored retirement account. Not all employers offer a 401k, but most of them do. Previously, employers offered pension plans to their employees, but they all started opting in for 401ks instead. With a pension plan, managing your investments was being done for you. But with a 401k, is being pushed to the employee to manage their own investments. With a 401k, you have a slew of options in different securities that you can invest in, such as mutual funds, index funds, ETFs, and even target date funds. The cool thing about target date funds is that you have an investment that automatically rebalances itself the closer it gets to your retirement age. So let's say you have a target date fund that says target date fund 2050. That means that the closer we're getting to the year 2050, that target date fund is automatically going to rebalance itself into a more stable, more conservative investment fund. Now, some additional cool things about a 401k is that most companies match your 401k contribution. So you might see something such as if you put in money, the company is going to match 4% dollar for dollar. For example, let's say you make $50,000 as your salary and you invest 4% of your salary into your 401k, 4% of 50k, $2,000. If a company matches dollar for dollar, they'll also add an additional $2,000 to your 401k. So you added the first 2,000, they add a second 2,000, now you have 4k in your retirement account. Now, you might also see something like a company matches up to 4%, but they only do 50 cents on the dollar. So you invest the dollar and they add 50 cents up to 4%. So with that same example, if you make 50k and you invest 4%, which is 2k, the company will match 50 cents on your dollar, so they will match an additional $1,000. Even though the company matches your contribution, there's still a vesting period that you have to look at. Because even if the company matches you dollar for dollar or dollar 50 cents, even 25 cents, if you look at the fine print, you will see that you need to work at a company for a few years before you're 100% vested. It might be 4 years, it might be 5 years. Every company is a little bit different. You will be limited when it comes to different options you have in investing in different funds or securities. These are always going to be limited by what the company has chosen for the employees. So you're going to have a limited amount of index funds to invest in. You're going to have a limited amount of even stocks, ETFs, or target date funds. Being limited by the number of options you have to invest in a 401k could be a good thing, but it could also be a bad thing. For an investor like myself, that's actually a bad thing because I want to be able to invest in whatever I want to invest in because I do the research. But if you're somebody that's new to investing or you're not that well versed when it comes to the stock market, then having a smaller list of options is probably best for you because otherwise you're going to get paralyzed when you have way too many options to choose from. Some employers also offer you a discount if you buy the company shares. With companies, you always want to do the research to know that you're investing in a high quality company. But I'm assuming that if you're working for the company, more than likely it's a great company to invest in also. There is a limit to how much you can invest in your 401k. Currently, it's a little over 20,000. Every single year, it gets raised up a little bit. And then also, if you're older, you can invest some additional capital in order to catch up. Currently, it's over $6,000. Some confusion happens when people talk about a traditional 401k versus a Roth 401k. So everything is pretty much the same between the two with the options you have when it comes to choosing your investments. but you are taxed differently when it comes to the traditional 401k and then the Roth 401k. The easiest way to remember this is that with a Roth 401k, you're investing with after tax dollars. And with a traditional 401k, you're investing with pre tax dollars. With a traditional 401k, when you hit retirement age, and you start taking out money out of your retirement account, that's when you're going to get taxed. With a Roth IRA, you're already taxed on the money that you're making, and then the money that's left, that's the money that you invest in your Roth IRA. And then when you hit retirement age, the money that you take out of your retirement account is not taxed at that moment. So which option should you go with? The traditional 401k or the Roth 401k? Now the cool thing about this is that you can have both. So you're not limited by having only one or the other. You can have both. But one thing to think about is if you hit that retirement age, are you planning on being at a higher tax bracket? Because keep in mind, with a traditional 401k, you get taxed when you take out your money during retirement age. So if you're envisioning yourself to be at a higher tax bracket, you might want to opt in for the Roth IRA instead. So it comes down to whatever works best for your situation at your retirement age. The money that you invest in your 401k, can you take it out before retirement age? Retirement age being 59 and a half. You want to be careful with taking any type of money out of your 401k because you might get hit with a penalty. So if you take money out of your 401k before retirement age, you will have to pay taxes more than likely, and then you will also get hit with a 10% penalty. There are some situations where you are able to take some money out of your retirement account. For example, if you're buying your first home, if it's a medical issue that you need to pay for, there are some exceptions where you can take money out and not be hit with a penalty. But definitely double check the rules when you want to take out any type of money out of your retirement account. You can also borrow some money from your 401k, but you will have to pay it back into your own 401k. But definitely check the fine print on some of these rules because they could slightly change. Now let's look at the next one, the IRA, the individual retirement account. You got the traditional IRA, but then you also got the Roth IRA. Now the IRA is really interesting because if you look at the 401k, you are limited in what you can invest in based on options that have been chosen for you. But with the IRA and the Roth IRA, you have the whole investing world available to you. So if you open up a IRA account, you can automatically invest in all the stocks, bonds, ETF, mutual funds, index funds, everything that's out there. That's a great benefit that the IRA has that the 401k does not have. A limitation of the IRA compared to the 401k though is that the amount that you can invest in your IRA per year is a lot lower than the 401k. Currently, it's over 6,000. Even with the IRA and the 401k, you're not limited by having either or. So you can have different 401k accounts in your name. Then you can also have different IRAs such as the Roth IRA and then the traditional IRA in your name. The thing that you need to keep in mind is that yes, you can have a Roth IRA and even a traditional IRA, but both still need to add up to your yearly limit in how much you can invest into your IRAs. So you can have both the 401ks and the IRAs. You're not limited by having either or. A good investor will have both because you might max out your 401k and you might have some additional money to invest. So go ahead and open up an IRA and invest that money in your IRA, which also gives you total access to the stock market and you're not limited to invest in specific securities. Now, same thing with the traditional IRA versus the Roth IRA. With the traditional IRA, you invest with pre-tax money, and then with the Roth IRA, you invest with after-tax dollars. So you will not get taxed when you take money out during retirement, and then with the traditional IRA, you will get taxed at your tax bracket when you take money out during retirement age. And then of course, some of the same penalties that you see with the 401k, those also apply to your Roth IRA and your traditional IRA. So you're not supposed to take out money before retirement because you'll get hit with the penalty and you might have to pay some additional taxes also. Keep in mind that the IRA accounts are not employer-sponsored accounts. So you're not going to get an employer match with these accounts. And also, if you want to open up an IRA or a Roth IRA account, you'll have to do that outside of work. You'll have to go to one of the big name brokers such as Fidelity, E-Trade, Ally, TD Ameritrade, etc. One thing you need to be careful with is having way too many investment accounts and retirement accounts open. So you work at one company, you open up a 401k, you end up moving to a different company after a year, you open up a new 401k, and then you move to a third company, you have a new 401k, and in the meantime, you also opened up a couple of IRA accounts here and there. What you need to start doing is condensing them and making sure that you don't have too many 401ks out there, because it's going to get confusing during tax time, and it's also going to be hard to keep up with having so many different 401ks open. Also, if you leave a 401k open at a previous employer, more than likely you're going to have to pay some additional management fees, and that's going to come out of your investment. So the best thing to do is roll over your 401k either into the new employer's 401k, or you can also roll over your 401k into your IRA. Make sure it matches. So you want your traditional 401k to roll over into a traditional 401k or a traditional IRA, and you want your Roth 401k to roll over into your new employer's Roth 401k. Now, whatever you roll it into, make sure that it works for you, because yes, you can take your 401k and roll it over into the new company's 401k, but then you will also be limited by what the company offers. Or you can take that 401k and then roll it over into an IRA, which pretty much means you will be able to skirt that 6.5 or 6,000 plus limitation for the Roth IRA, and then you'll be able to invest in whatever you want to invest in. So all this might still be a little bit confusing because you're just starting with investing and you're like, okay, Gio, I just want to invest. I have X amount of money. I just want to start investing. I don't want to know about penalties. I don't want to know about different rules. I don't want to know about rollovers. What should I do? Well, the easiest thing you can do is start a traditional brokerage account, also just called a brokerage account, with a company like Robinhood and even Ally, TD Ameritrade, etc., etc. Just open up a brokerage account. You don't have to worry about penalties, selling your shares, selling your stock, and then get hit with a fee. Because with a traditional brokerage account, you can buy and sell, you can day trade, you can swing trade. Now, also with a traditional brokerage account, you can open up a margin account. With a margin account, you're allowed to invest with borrowed money. Investing in itself is already very risky, but then tacking on borrowed money, that means that you're bringing your investing risk to a new level. Investing with a margin account and investing with borrowed money, as long as your funds don't fall below a certain level, you will not get a margin call. Whenever you get a margin call, this pretty much means that you need to get your funds up back to a specific level by either selling the investments that you own in your margin account, or you need to deposit some new capital in your margin account. But yes, investing with a margin account should only be left for the professionals out there. Don't start opening up margin accounts if you're new to investing. So even if I think about all these different accounts, the way I would do it is, if you have a employer sponsored 401k and they offer a specific match, I would definitely start there first. Make sure you are invested in your 401k because you're going to get the match. Then the next thing I would do is open up a IRA and invest some additional money into my IRA, which will give me the option to invest in whatever I want to invest in. I'm not limited with investing in only specific securities like with the 401k. And then once I have that set up, I'll open up a traditional brokerage account, and I can use that traditional brokerage account to pretty much experiment and have fun with investing. For example, you can open up a Robinhood account, deposit some money in there, start buying shares, fractional shares, dividend paying stocks, and see how you're able to fare in the stock market and grow your wealth. If you're self-employed, you also have access to similar retirement accounts. So some of these are going to be the solo 401k, the SEP, which is the simplified employee pension, the simple IRA, and then the defined benefit plan. And as always, make sure you like this video if you liked today's topic. And also in the comment section, let me know your favorite retirement account or the different retirement accounts that you currently have. And then make sure to subscribe to my channel, and I'll talk to you guys in the next video.